Hello, this is Market Matters. I'm Charlotte Chong. This is Khoo Chong. Charlotte, Emas Kiara Industries Bhd. It's just
so am I Charlotte or Chuang?
Sorry.
No.
Chong. Yeah, okay. This engineering company, Emas Kiara Industries Bhd, they have gotten an offer, a mandatory general offer from their major owner, Kim Feng Capital, having last bought additional shares of the business to take them to 47% of the business. They bought it at 80 cents a share. Now they've offered to take the whole company private at 80 cents a share. The only problem is they closed the day at 98 cents, which means it's a huge premium of 16 cents over the offer.
So if you are the shareholder, will you sell it to the offerer or the open market, 98 cents? Of course, 6% up to 98 cents today. Now the news is Main Street independent advisor of the company, they came up with a report saying that based on its evaluation as a whole, they are of the view that the offer is not fair but reasonable to the holders. So does that mean that shareholders should sell it to the open market or to the holders?
I don't understand. Independent advisors, they use such language, saying not fair but reasonable. So what is fair but why is it not reasonable? And I blame Simon and Cindy Sim because they as the owners of Kim Feng Capital. I guess this is a little bit underhanded because it's such a thinly traded stock. It's been underwater and so thinly traded for the last few months. They have decided to take the company private, and because of the rumors that have been spread into the market, it's now come up to a point where it's now 98 cents versus the offer price of 80 cents. So is it fair? I don't think so. Is it reasonable? I guess so. So in that technical sense, Main Street is not wrong.
But having said that, independent advisor Main Street actually say that they recommend the holders should actually accept the offer by this company. Now, Simon Sim and Cindy Sim, they intend to maintain the listing status of EKIB. I think it's sort of like a backdoor listing sort of exercise.
Well, I guess it is. I guess it is. And of course, they're going to move away from engineering into property development. They have completed this exercise by buying a 45 million ringgit Pinnacle Tower development in JB City Centre. That's got a profit guarantee of 51 million ringgit. So I'm not sure whether this is such good advice from the independent advisors suggesting to the shareholders to take the offer, because you could stick around and get all the benefits from this rental income.
Well, the acquisition was 45 million and they have a profit guarantee of 51 million. So they earn a fair bit from there. And this particular development, Pinnacle Tower in Johor, is scheduled for completion in 2017. Project with gross development value GDV of 260 million ringgit, comprises of 273 units of high-end service apartments. But I'm not sure, do you think Johor still attracts that kind of demand?
I think so. I mean, the whole retail trend and growing affluence theme is still intact. If you take the offer as Main Street advised you to do, you're basically selling your shares at a low, because in the last couple of years it's been very weak for Emas Kiara, and then you're not getting any of the upside from the profit guarantee from Pinnacle. So I'm not sure why you would take the whole offer, especially when the offer is 16 cents lower, 18 cents lower than the offer price.
So let's look at the earnings. Third quarter, actually net profit 6.5 million ringgit, revenue up 16.6% to 12.3 million ringgit.
Okay, so to wrap up for Emas Kiara, they have gotten an unconditional takeover offer from the major owner at 80 cents a share, and their independent advisor, Main Street, has suggested to shareholders to take the offer. Let's move along to this stock called Pharmaniaga. Now, of course, it is a broker's call, and Kenanga is looking at the stock. It's Pharmaniaga, of course, the drug maker. They closed the day in fact, 1/3% lower to 617. Now, of course, earnings have just been announced. Pre-tax profit have fallen to 113 million ringgit from 126 a year ago. Revenue was up to 2.2 from 2.1 billion ringgit. And Kenanga have called this a market perform stock.
Now, what happened was year-on-year, FY15 net profit fell 10% to 84 million ringgit, despite a flattish turnover, primarily attributable to reduced government orders. So basically, government sent out lesser orders to Pharmaniaga Bhd.
Yeah, of course, as we know, Pharmaniaga is the prime beneficiary because they are the sole concession holder to buy, store, supply and distribute approved drugs and medical products to all 148 government hospitals and 1,400 clinics around the country nationwide. The only problem is this concession ends in 2019, which is in 3 years' time.
Now, Kenanga actually downgrade its
right.
FY16 estimate net profit by 8%. Because of taking into account the higher than expected operating costs in the future and also amortization of PHIS system.
That's right. The other reason for the downgrade from Kenanga is the fact that Pharmaniaga has actually risen by 50% since they began coverage in November 2014. So time to take some money off the table. Okay, additional risks in terms of Kenanga's outlook, lower than expected volume sales. And to wrap it all up, in terms of Pharmaniaga, Kenanga has downgraded the net profit for FY 2016 for Pharmaniaga by 8% to take into account the higher costs of the software system. Number two, they've downgraded the stock to market perform and cut the target price from 695 to 640 based on a valuation of 16.5 times earnings. And they have, of course, told shareholders to sell because the stock has risen by more than 50% in the last year and a bit. That's a wrap for us for Market Matters, Chuang. Thank you for joining us. If you want to take in more information from The Edge, you can always buy the daily from all good newsstands as well as the weekly on a weekly basis. Thank you for watching.